All right, guys, welcome to a brand new week ahead. It's been a crazy couple of trading sessions over the last 2 weeks. Volatility has just been all over the place. If you take a look at this chart, this is looking at cross-asset volatility. Top left, we've got VIX. Here we've got a composite of a dollar composite of implied volatility, mainly focused on the dollar, but looking at the various major pairs. Bottom left, we have the OVX, which is oil volatility. And then bottom right, we have the MOVE index, which is bond market volatility. And you can just see the massive spikes we've seen over the course of the last 2 weeks. It's just been absolutely crazy from a volatility point of view. I mean, when you think about it from a price action point of view, we've seen some crazy things. Starting with equities, we dipped into bear market territory for the S&P, down just over 20% just a couple of sessions ago, bouncing back by another 11%. If you take a look at things like oil, we traded back down to 4-year lows. The dollar traded down to 2-year lows. Euro dollar ramped up to 115. Gold trading at all-time highs as well. It's just been an absolute monster of a volatility week last week, and obviously the last 2 weeks in total. So where does that leave us coming into the new week? Well, we do start the week with slightly better news on the tariff side, because we had the Trump administration coming out over the weekend saying that they are exempting a couple of products, things like a smartphone, semiconductors, chips, laptops, other types of computer equipment, all being exempt from all of the tariffs that's been placed on over the course of the last couple of weeks now. Now, that should be a positive driver for equities at the open. If we quickly take a look at where those charts are trading, we have seen obviously a nice recovery move in equities, up 11% in terms of the S&P from their recent lows. This news should, as a bare minimum, see a little bit of a gap to the open, possibly seeing equities trade higher. It'll obviously be very important for us to watch things like tech a little bit more. Looking at the NASDAQ, obviously you've got those big weightings, names like Apple, Microsoft, Nvidia. This news will be important to watch for those names. And it shouldn't be too much of a surprise to see a little bit of a pop to the upside in equities on the back of that, more specifically driven, like I said, by those technology names. Now, when it also comes to equity, something important for us to watch this week is we do obviously have, it's a brand new quarter, so we do have earnings season kicking off as well. We've got a couple of names coming up this week, not massive in terms of those big tech names. We do have a couple of bank names coming up, but as always, we need to look at the weighting, right? If you look at names like Goldman Sachs, names like Johnson & Johnson, Travelers Companies, as well as United Health, these aren't normally massive names in the context of things like Apple or Microsoft. But what does make them important is if we take a look here on the right-hand side, you can see when it comes to the Dow Jones, all of these names have a very high weighting, right? You've got a 7% weighting for Goldman, for example, a close to 10% weighting for United Health. What does that mean? It means that regardless of what happens to tech at the open, this week we have earnings coming up for these names. And because they have such a high weighting in the likes of the Dow Jones, these names will be important to watch for the Dow, and obviously just broader sentiment as well. Apart from these weighted names, what the markets will be watching this earnings season is obviously what does these companies have to say about tariffs, right? How do they think, or how are they seeing tariffs impacting their pricing pressures, right? Are they seeing a lift in core good pricing? How is that going to translate into end product pricing for them, right? Those things will be important to watch, because that'll give us a look at what we could expect from inflation. Secondly, what does the recent tariff news, what does it mean for them from a demand point of view? Are they already seeing sales dropping off? Are they seeing some supply chain shifts already happening? These types of things will be very important for us to watch in this earnings season. So regardless of the names, regardless of what happens at the open with tech, what happens this earnings season in terms of pricing pressures and obviously demand, that'll be critical for us to watch when it comes to these names. Now, the other thing we need to watch in lieu of this tariff situation, we obviously had some exemptions coming out last week, the 90-day pause from the Trump administration. Something we need to watch in line with this, and obviously in line with the news about the exemptions over the weekend, is what will happen to the bond market this week. The bond market did something that very, very, very few of us anticipated, right? Normally, when you see this type of stress in equities, when you see this type of ramp up in volatility, normally, US Treasuries has always been seen as this safe haven, right? This place where investors run to for safety, because you would never expect the US to default on their debt. However, what we saw from last week is that we've seen a huge erosion in confidence in the US, right? We've seen that obviously portrayed by the bond market, where despite all of the nonsense that was happening, despite all of the fear, people didn't rush into treasuries, right? We actually saw treasuries being dumped across the board, obviously forcing those bond yields higher. Now, that is not a good look for your currency, right? And this is counterintuitive, because normally higher yields in most scenarios, right? Higher yields is positive for your underlying currency. In this scenario, when stuff like this happens, it's not good, right? Think back to the mini budget that we had from the previous UK government. The mini budget was an absolute shamble, right? And what happened to yields there is you saw yields spiking up because of fiscal uncertainty, and that move in yields wasn't positive for the pound at the time. And in the same way, this move in yields to the upside for the US, it just hasn't been a positive driver for the US dollar, and the dollar has been pushing lower as yields have been pushing up. So that's going to be a key one to watch this week. If we do see a little bit of a reprieve in those treasuries selling and that pressure to the downside, obviously bringing yields lower, that could actually create a little bit of room for some recovery in the US dollar. I wouldn't be too excited about jumping into US dollar longs here. I mean, maybe the positive news from the exemptions could see a little bit of a lift in the US dollar, but it still feels, sentiment is still eroded, right? So we need to be careful here. Look, from a positioning point of view, if we take a look at positioning data, the dollar is still the biggest stretch short among the major currencies, with the yen and the euro being the biggest net longs. So yes, there is room from a pure mean reversion point of view to look for some upside here in the US dollar, but it's going to be risky, right? It's going to be risky given the amount of negative sentiment in play. And again, we'll need to watch and see what happens to the bond market. If treasuries can pick up a little bit and yields can come down a little bit, then maybe that could be a bit of a trigger to use for some mean reversion in the US dollar. But we need to be very careful on that front. Now, the other thing that we need to watch a little bit later in the week is China data, obviously still in relation to tariffs. That is the GDP data that we get. Let me just quickly find it here for us. Here we go, on Thursday. So China GDP data. This is going to be an important one for us to watch. This is the first look that we get at Chinese GDP for Q1. Now, it's important here to understand that the most recent escalation that we've had with tariffs going to, what is it now, 145% or whatever for China, it's just ridiculous. But at that level, that isn't included or wasn't included in the Q1 tariff that was placed on China, right? Then it was a much smaller number. But what the markets will use this for is to get a sense of how growth has potentially been impacted with that first initial bout of uncertainty and that first initial amount of tariffs being placed on China. So if we were to see much better than expected GDP numbers coming out for China, that could be quite positive for risk, right? Because that'll show that the impact, at least up until then, has been rather limited. Obviously, it could be much worse given the recent numbers that we've seen. But if we were to see growth coming in a little bit better here, that could be positive for risk sentiment. It could also be positive for those very reliant currencies like the Aussie and the Kiwi, which we'll touch on in a second as well. So that's something to watch. If it's really bad data, right? If we see growth just absolutely smash lower, a number like, sub 4, if we were to get anything with a 3 handle on it, the markets will probably freak out a little bit. We could see a little bit of bad sentiment coming out on the back of that. It could also weigh on those currencies like the Aussie and the Kiwi. But if we were to see growth really surprise to the downside, something we need to be watching very carefully for is any potential stimulus measures being announced by the Chinese government, right? They've already mentioned last week that they are looking at ways of trying to protect their interests, trying to protect their economy, boost growth in the midst of tariffs. So if we were to get really bad numbers, that will obviously be a negative at first for sentiment and a negative at first for things like the Aussie and the Kiwi. But if we were to get some real punchy good looking stimulus coming out, that could be really good for sentiment again. That could potentially open up some opportunities to look at some upside for the China A50, maybe some upside there in Chinese equities. Alternatively, just some upside in the likes of the Aussie and the Kiwi as well, potentially versus the US dollar. So if we take a look at where the Aussie is trading right now, the Aussie dollar, we can see we're trading just shy of that 64 psychological level. It has been a key area of resistance for this pair for quite a while. So that'll be a first key tough nut to crack if we were to get some positive sentiment news. And obviously, if that folds, we could be looking at some higher moves, maybe back up towards that 65, even the 66 cents level. So definitely something worth watching. It's not just about the data, but it's also going to be about how potentially we see the Chinese government respond to that. So that's something definitely interesting to watch. Apart from that, look, we've got a couple of key data points coming up this week, but what's important to keep in mind about this week specifically is, remember, Friday is Easter holiday, right? Or Easter weekend. So what would we expect in a week like this? We would expect thinner liquidity on the back of that. We would expect lower volumes on the back of that. And you would expect that a couple of desks might be closing a little bit early, even on Thursday as we move into the weekend. So it's, even though we have a bunch of data coming up, the fact that it's Easter weekend does complicate the way that the markets might look to trade that data, right? That's the first thing to keep in mind. The second thing to keep in mind is that even though we have data coming up for places like Canada, for the UK, we'll touch on that in a second, even Australia and Kiwi and New Zealand. The challenge with a week like this is that, firstly, we've got Easter, the Easter weekend, which complicate the volatility and the liquidity. But secondly, it's all still about the tariff situation, right? So how much will the markets really be paying attention to these data points, apart from Chinese GDP, that is? I don't think there's going to be a lot of focus on these things. But as always, we'll need to keep an eye on it. So what do we have coming up? Let's touch on the UK first. We have jobs data as well as CPI data coming up from the UK. Look, I'm not expecting a lot from this. If we take a look at market pricing, we can see that the markets are already close to fully priced for a cut at that May meeting. So I suppose if we were to see a massive upside surprise in CPI, maybe that sees the markets trim down that 23 basis points, maybe down to a 20, maybe lower. Obviously, if it's a big miss across the board, that'll just see the markets fully pricing in that cut. Is that going to be a big driver for the UK in a week like this? I would argue no. The one reason, as I said, is Easter, the fact that it's, the tariff situation. The second reason, though, is that we didn't see any meaningful impact in the likes of the pound with last week's data coming out of the UK. So will we suddenly start seeing an impact this week? I don't know, probably not. So it's one to watch as always, but it's not data that I'm at all interested or excited about trading this week. Now, what we also have is Canadian CPI data coming up, I believe, on Tuesday, and then we have the Bank of Canada coming up on Wednesday. Now, the Bank of Canada is in such a difficult spot right now. On the one side, they had activity data coming in slightly better. They had CPI coming in slightly better. But on the opposite side, they have labor data, which looks very, very ugly. And there's that big problem of being tariffed by your biggest trade partner, right? If you take a look at this data, this is looking at 2023 data. The United States back in 2023 made up 71% of Canada's exports. So it's all about tariffs right now. It's all about tariffs. It's all about how those tariffs will impact the broader economy. So it's a touch and go one when it comes to the Bank of Canada. You can see here that the markets aren't sure what's going to happen with the bank's decision. There's about 9 basis points of easing price already. That means the markets is looking at about a 61% probability of a cut. It can go both ways, right? And from a day trader perspective, if we were to see a cut playing out, you could look for some short-term downside in the Canadian dollar. If we were to see a surprise hold, that could see a little bit of upside in the Canadian dollar. But it's all going to be down to what the bank has to say. And at this stage, what more can they say about, we don't know what's going to happen. We don't know what the final numbers will be. We don't know how this is going to impact the economy yet. They basically have to wait and see. So I'm not expecting a lot from this. Again, from a pure day trader point of view, a scalper point of view, if we were to see either a cut or a hold, it should see the markets react, because right now we're at a 60%. So whether we cut or hold, it's going to have a reaction in the short term, and that could be tradable. Anything more than that is probably not going to be interesting to trade when it comes to that rate decision. Now, the other one we have is the ECB. Now, I'm not sure whether the ECB is even going to be relevant for the euro right now. I mean, if you take a look at the euro dollar, the euro dollar hasn't, this move to the upside, especially that break that we had up to 115 last week. This move up to 115 wasn't because of the ECB or because of the rate cut that is already priced in for this coming week. It's all about confidence being eroded in the US dollar, firstly, and secondly, that massive fiscal stimulus that is planned in Germany. So will either one of those two things change the ECB's mind this week? Probably not. The market's already fully pricing in a cut for the bank, 100% probability of a cut. So if they cut rates and they just kind of kick the can down the road, we wouldn't expect that to have any meaningful impact in the euro this week, right? Now, if they were, for whatever reason, to hold rates surprisingly, maybe because of tariffs, maybe there's uncertainty about how that's going to impact inflation. If they come out and they surprise massively with a hold, then obviously the euro could see an even bigger rip like the one that we had last week. If we take a look at some key levels for the euro dollar, we've got the weekly implied volatility high coming up around that 115 psychological level, as well as the recent highs from last week. So that's going to be a key barrier resistance to watch going into the week ahead. Apart from that, we've got the weekly low implied volatility coming up around that highs going back to the 3rd. So we've got some pretty key levels to aim for to the up and to the downside. But again, I'm not sure whether the ECB will give us any meaningful moves there. Like I said, if they were to hold rates when everybody's expecting them to cut, that could see some additional upside. But if they do cut rates, we wouldn't really expect that to have any meaningful impact. Maybe we see some profit taking playing out for the euro. I mean, we've had a monster rip all the way from, where were we trading at just a couple of weeks ago? All the way from 105 back up to 115. So maybe if we do see a cut from the bank, maybe that opens up some profit taking, which could see the euro dollar pushing lower. But again, it's not something we'll be too excited about trading this week. Now, we also have some other data coming up this week in the form of jobs data for Australia, quarterly CPI data for New Zealand. Look, from a short-term point of view, these things can matter and they can be market moving. But right now, the focus for these currencies is all on tariffs. I mean, take a look at this. This is the expected amount of easing that is expected by the markets for the major central banks by the end of the year, right? It's no surprise that the RBA and the RBNZ is the ones that is expected to cut the most, because the biggest impact right now is on China. So again, will the data matter? Yes, it can. The bigger focus, I think, will be on what happens to Chinese GDP and whether we get any further conciliatory comments coming out, whether we get any further exemptions, and obviously whether we get some possible stimulus coming out from them. In terms of key levels, like we said, let's just quickly take a look at where we are trading for the weekly levels here for the Aussie. Weekly levels coming up right on top of those recent highs. So that's a very nice confluence there for the Aussie. That'll be key resistance to watch in the event that we do get some stimulus news coming out. We looked at the euro. Let's quickly take a look at the S&P. In terms of weekly implied volatility, that comes up around that 55.50 level, which is very close to that recent resistance, support and resistance around the 55.20 anyway. So that's a key level to watch to the upside. Key support then would be those lows going back to the 10th, which is also the implied volatility for the week, the implied volatility low for the week. So it's a busy week, but it's also going to be a messy one with the holiday coming up. So just be mindful of the damage that can do to liquidity as well as volume. It's going to be a messy one. Watch out for tariff news. Watch out how we see that reaction playing out at the open. And then, of course, as always, if there's any questions, don't hesitate to reach out and let me know.